International economics is concerned with the effects upon economic activity from international differences in productive resources and consumer preferences and the international institutions that affect them. It seeks to explain the patterns and consequences of transactions and interactions between the inhabitants of different countries, including trade, investment and migration. International trade studies goods and services flows across international boundaries from supply and demand factors, economic integration, international factor movements, and policy variables such as tariff rates and trade quotas. International finance studies the flow of capital across international financial markets, and the effects of these movements on exchange rates. International monetary economics and international macroeconomics study flows of money across countries and the resulting effects on their economies as a whole. International political economy, a subcategory of international relations, studies issues and impacts from, for example, international conflicts, international negotiations, and international sanctions, national security and economic nationalism, and international agreements and observance. International trade, scope and methodology. The economic theory of international trade differs from the remainder of economic theory mainly because of the comparatively limited international mobility of the capital and labor. In that respect, it would appear to differ in degree rather than in principle from the trade between remote regions in one country. Thus, the methodology of international trade economics differs little from that of the remainder of economics. However, the direction of academic research on this subject has been influenced by the fact that governments have often sought to impose restrictions upon international trade, and the motive for the development of trade theory has often been a wish to determine the consequences of such restrictions. The branch of trade theory which is conventionally categorized as classical consists mainly of the application of deductive logic, originating with Ricardo's theory of comparative advantage and developing into a range of theorems that depend for their practical value upon the realism of their postulates. Modern trade analysis, on the other hand, depends mainly upon empirical analysis. Classical theory, the law of comparative advantage, provides a logical explanation of international trade as the rational consequence of the comparative advantages that arise from interregional differences, regardless of how those differences arise. Since its exposition by David Ricardo, the techniques of neoclassical economics have been applied to it to model the patterns of trade that would result from various postulated sources of comparative advantage. However, extremely restrictive assumptions have had to be adopted in order to make the problem amenable to theoretical analysis. The best known of the resulting models, the Heckscher-Ohlin Theorem, depends upon the assumptions of no international differences of technology, productivity, or consumer preferences, no obstacles to pure competition or free trade, and no scale economies. On those assumptions, it derives a model of the trade patterns that would arise solely from international differences in the relative abundance of labor and capital. The resulting theorem states that, on those assumptions, a country with a relative abundance of capital would export capital-intensive products and import labor-intensive products. The theorem proved to be of very limited predictive value, as was demonstrated by what came to be known as the Leontief paradox. Nevertheless, the theoretical techniques used in deriving the HO model were subsequently used to derive further theorems. The Stolper-Samuelson theorem, which is often described as a corollary of the HO theorem, was an early example. In its most general form, it states that if the price of a good rises, then the price of the factor used intensively in that industry will also rise, while the price of the other factor will fall. In the international trade context for which it was devised, it means that trade lowers the real wage of the scarce factor of production, and protection from trade raises it. Another corollary of the HO theorem is Samuelson's factor-price equalization theorem, which states that as trade between countries tends to equalize their product prices, It tends also to equalize the prices paid to their factors of production. Those theories have sometimes been taken to mean that trade between an industrialized country and a developing country would lower the wages of the unskilled in the industrialized country. Large numbers of learned papers have been produced in attempts to elaborate on the Heckscher and Stolper Samuelson theorems, and while many of them are considered to provide valuable insights, they have seldom proved to be directly applicable to the task of explaining trade patterns. Modern trade analysis moves away from the restrictive assumptions of the Heckscher theorem and explores the effects upon trade of a range of factors, including technology and scale economies. It makes extensive use of econometrics to identify from the available statistics the contribution of particular factors among the many different factors that affect trade. The contributions of differences of technology have been evaluated in several such studies. The temporary advantage arising from a country's development of a new technology is seen as a contributory factor in one study. Other researchers have found research and development expenditure, patents issued, and the availability of skilled labor to be indicators of the technological leadership that enables some countries to produce a flow of such technological innovations, and have found that technology leaders tend to export high-tech products to others and receive imports of more standard products from them. Another econometric study also established a correlation between country size and the share of exports made up of goods in the production of which there are scale economies. The study further suggested that internationally traded goods fall into three categories, each with a different type of comparative advantage. Goods that are produced by the extraction and routine processing of available natural resources, such as coal, oil and wheat, for which developing countries often have an advantage compared with other types of production, which might be referred to as Ricardo goods. Low-technology goods, such as textiles and steel, that tend to migrate to countries with appropriate factor endowments, which might be referred to as Heckscher-Ohlin goods, and high-technology goods and high-scale economy goods, such as computers and aeroplanes, for which the comparative advantage arises from the availability of R&D resources and specific skills and the proximity to large sophisticated markets. There is a strong presumption that any exchange that is freely undertaken will benefit both parties, but that does not exclude the possibility that it may be harmful to others. However, Paul Samuelson has proved that it will always be possible for the gainers from international trade to compensate the losers. Moreover, in that proof, Samuelson did not take account of the gains to others resulting from wider consumer choice, from the international specialization of productive activities, and consequent economies of scale, and from the transmission of the benefits of technological innovation. An OECD study has suggested that there are further dynamic gains resulting from better resource allocation, deepening specialization, increasing returns to R&D, and technology spillover. The authors found the evidence concerning growth rates to be mixed, but that there is strong evidence that a 1% increase in openness to trade increases the level of GDP per capita by between 0.9% and 2.0%. They suggested that much of the gain arises from the growth of the most productive firms at the expense of the less productive. Those findings and others have contributed to a broad consensus among economists that trade confers very substantial net benefits, and that government restrictions upon trade are generally damaging. Factor price equalization. Nevertheless, there have been widespread misgivings about the effects of international trade upon wage earners in developed countries. Samuelson's factor price equalization theorem indicates that, if productivity were the same in both countries, the effect of trade would be to bring about equality in wage rates. As noted above, that theorem is sometimes taken to mean that trade between an industrialized country and a developing country would lower the wages of the unskilled in the industrialized country. However, it is unreasonable to assume that productivity would be the same in a low-wage developing country as in a high-wage developed country. A 1999 study has found international differences in wage rates to be approximately matched by corresponding differences in productivity. It has been argued that, although there may sometimes be short-term pressures on wage rates in the developed countries, competition between employers in developing countries can be expected eventually to bring wages into line with their employees' marginal products. Any remaining international wage differences would then be the result of productivity differences, so that there would be no difference between unit labor costs in developing and developed countries, and no downward pressure on wages in the developed countries. Terms of trade. There has also been concern that international trade could operate against the interests of developing countries. Influential studies published in 1950 by the Argentine economist Raoul Prebisch and the British economist Hans Singer suggested that there is a tendency for the prices of agricultural products to fall relative to the prices of manufactured goods, turning the terms of trade against the developing countries and producing an unintended transfer of wealth from them to the developed countries. Their findings have been confirmed by a number of subsequent studies, although it has been suggested that the effect may be due to quality bias in the index numbers used or to the possession of market power by manufacturers. The Prebisch-Singer findings remain controversial, but they were used at the time, and have been used subsequently, to suggest that the developing countries should erect barriers against manufactured imports in order to nurture their own infant industries, and so reduce their need to export agricultural products. The arguments for and against such a policy are similar to those concerning the protection of infant industries in general. Infant industries. The term infant industry is used to denote a new industry which has prospects of gaining comparative advantage in the long term, but which would be unable to survive in the face of competition from imported goods. This situation can occur when time is needed either to achieve potential economies of scale, or to acquire potential learning curve economies. Successful identification of such a situation, followed by the temporary imposition of a barrier against imports, can, in principle, produce substantial benefits to the country that applies it, a policy known as import substitution industrialization. Whether such policies succeed depends upon the government's skills in picking winners, with reasonably expectations of both successes and failures. It has been claimed that South Korea's automobile industry owes its existence to initial protection against imports. But a study of infant industry protection in Turkey reveals the absence of any association between productivity gains and degree of protection, such as might be expected of a successful import substitution policy. Another study provides descriptive evidence suggesting that attempts at import substitution industrialization since the 1970s have usually failed, but the empirical evidence on the question has been contradictory and inconclusive. It has been argued that the case against import substitution industrialization is not that it is bound to fail, but that subsidies and tax incentives do the job better. It has also been pointed out that, in any case, trade restrictions could not be expected to correct the domestic market imperfections that often hamper the development of infant industries. Trade policies. Economists' findings about the benefits of trade have often been rejected by government policymakers, who have frequently sought to protect domestic industries against foreign competition by erecting barriers, such as tariffs and quotas, against imports. Average tariff levels of around 15% in the late 19th century rose to about 30% in the 1930s. Following the passage in the United States of the Smoot-Hawley Act, mainly as the result of international agreements under the auspices of the General Agreement on Tariffs and Trade and subsequently the World Trade Organization, average tariff levels were progressively reduced to about 7% during the second half of the 20th century, and some other trade restrictions were also removed. The restrictions that remain are nevertheless of major economic importance. Among other estimates, the World Bank estimated in 2004 that the removal of all trade restrictions would yield benefits of over $500 billion a year by 2015. The largest of the remaining trade-distorting policies are those concerning agriculture. In the OECD countries, government payments account for 30% of farmers' receipts and tariffs of over 100% are common. OECD economists estimate that cutting all agricultural tariffs and subsidies by 50% would set off a chain reaction in realignments of production and consumption patterns that would add an extra $26 billion to annual world income. Quotas prompt foreign suppliers to raise their prices toward the domestic level of the importing country. That relieves some of the competitive pressure on domestic suppliers, and both they and the foreign suppliers gain at the expense of a loss to consumers, and to the domestic economy, in addition to which there is a deadweight loss to the world economy. When quotas were banned under the rules of the General Agreement on Tariffs and Trade, the United States, Britain and the European Union made use of equivalent arrangements known as voluntary restraint agreements or voluntary export restraints, which were negotiated with the governments of exporting countries, until they too were banned. Tariffs have been considered to be less harmful than quotas, although it can be shown that their welfare effects differ only when there are significant upward or downward trends in imports. Governments also impose a wide range of non-tariff barriers that are similar in effect to quotas, some of which are subject to WTO agreements. A recent example has been the application of the precautionary principle to exclude innovatory products.